In this lesson, we will learn about basic acquisition financing. This lecture will cover the following. 1. What is acquisition financing? 2. Key financing sources. 3. Debt versus equity considerations. 4. Understanding key dimensions of financing. 5. Case study. Choosing the right mix of financing sources is fundamental to a successful acquisition. Let's break down the key options: debt, mezzanine, and equity, to understand their unique characteristics and roles in deal structures. Debt financing. The backbone. Debt financing involves borrowing funds from lenders such as banks and institutional investors or issuing bonds. It is generally secured by the assets of the company being acquired or other corporate assets. Key features. Contractual repayment. Lenders are entitled to regular interest payments along with the return of the principal amount on a fixed schedule. Seniority. In case of default, debt holders generally have priority claims on a company's assets compared to equity holders. Mezzanine financing. A flexible middle ground. Mezzanine sits between debt and equity on the risk spectrum. It often combines features of both. Debt elements. These can include regular interest payments and a fixed maturity date. Equity elements. These may involve kickers like an option to acquire a stake in the company in the future. Key features. Hybrid form. Mezzanine financing fills in when a company needs more than traditional debt, but doesn't want to give up as much control as would be required with equity. Flexibility. Due to its higher risk, it is more expensive than senior debt, but it offers flexibility in terms of payment schedules and is often used to bridge gaps in financing. Equity financing. Funding with ownership. Equity financing involves selling a portion of a company's shares to raise funds, which dilutes ownership but does not require repayment. This makes it an attractive option for companies that expect high growth potential from the acquisition and are willing to share future profits with new shareholders. Key features. No fixed repayment. Unlike debt, there are no mandatory interest or principal payments, providing financial flexibility. Ownership stake. Investors gain rights to a portion of the company's future profits and a say in decision-making. Risk-return profile. Equity investors expect higher returns than debt providers to compensate for the additional risk they assume. Potential for high upside. If the acquisition is successful, equity investors stand to gain significantly as the company grows.